All right, you're now recording. All right, so in this class, we look at these different units of measures as responsibility centers. Okay? So there's 4 different types of centers that we think of. The first one is a cost center. Okay? So when you're a cost center, your only job is to manage the costs, right? You're just focused on, let's control how much money we spend. Okay? An example of that would be, say, the legal department for Yum. Okay? The legal department at Yum, they are not generating revenues, right? Their whole job is to control the cost. Let's limit the amount of money that we're spending on legal fees, whether it's paying for our own in-house attorneys, hiring outside attorneys, settling lawsuits, right? They're evaluated based off of their ability to say, you've got a $20 million budget. How much little of that can you spend? Does that make sense? They're strictly a cost center. A revenue center is focused strictly on revenues. How much revenues can we generate? Think of a sales department or sales guy, his or sales gal. His or her only responsibility is, how do I sell this? I just want to sell as much as I can. Okay? So you usually see people in the sales division, they have a higher expense account, a budget where they can go, well, they can't do it anymore, but they would take people to concerts and take them to, hey, get out. Nobody wants to see you dance. Okay, later. You can see people, they used to take them to concerts and out to fine dinners, because their focus is how much revenue you generated. Okay, so the sales team are just focused on the revenues, generating revenue. So you have cost centers, you have revenue centers, you also have what are called profit centers. Okay, so these are people that are responsible for both generating revenue and managing expenses. Okay. So if we go back to this Yum example, that would be, for example, the Taco Bell store on Marina Boulevard in San Leandro. They want to maximize their revenues and they want to minimize their costs, right? So they're thinking about how many people are we hiring, how much inventory are we purchasing on a daily or weekly basis. They're making these types of decisions so that they can make sure they're maximizing their profitability.
But doesn't that mean that the profit center basically does like the revenue and cost center's job?
Say that again?
But pretty much like the profit center, in a way, kind of does both the cost center and revenue center's jobs?
Yes. The profit center is responsible for both the revenue and the cost.
So like overseeing it a little bit?
Yes.
Okay.
So the fourth one is the investment center. The investment center, not only are they looking out for profit, they're looking to maximize profit, they're also making decisions about investment. And making sure that whatever investment they make, whatever capital purchase they make, buying new equipment, purchasing a new vehicle, leasing a new building, that's going to produce a return on their investment. So in this Taco Bell, KFC world, think of the regional manager responsible for the Taco Bells in the Bay Area. He or she has to think about, does it make more sense to put a new Taco Bell in Oakland? And is that Taco Bell in Oakland going to compete with the Taco Bell that's in San Leandro, right? Because there's going to be a capital investment that needs to take place. We need to find a space. We need to convert the space so that we can use it. We need to hire. We need to pay for the signage, reconstruct the drive-through, right? There's all these initial costs that have to go in, investments that need to be made, and they're evaluating that process as well. What questions do you have? All right, well then I will ask some questions. In your books, I don't know if you have your books with you, but I do. Actually, I don't, but it's on my iPad. If you go to S10-2 in your book, and I wish I could give you a page number if you have a physical book with you. My book is in Livermore, and I cannot go on campus unless I call the dean and we do a video conference, and I have to convince him I'm not sick. And I just don't feel like doing all that. Plus it's far. So here we are. All right. So S10-2, let's just walk through this, and I want you guys to think about what type of responsibility center each one of these will be. Okay? And I feel like I should probably do this in a poll. So hopefully you all can see this poll. So let me read to you what this is. Baskin-Robbins is a subsidiary of Dunkin' Brands. Dunkin' Brands owns and operates nearly 2,500 ice cream specialty stores in the United States. Go ahead and submit your guess, your educated guess. Is this a cost center, revenue center, profit center, or investment center?
Do we get to see what everyone does, or do you just get to see it?
Oh, I just get to see it.
Oh.
Why, you want to see?
Oh, I just want to see what the
see?
ratings were between all the answers, because that's what usually like shows in class.
Oh,
it's okay.
We've only got 66% of the people voted. All right, you guys got to vote a little faster.
I'm still trying to find the page or what you're looking at or the question that you're giving us. Is that at the end of the chapter 10? Or is it on?
Yes, short exercise number 2.
I walked away to grab my book.
All right, time's up.
All right. Wow.
I think it's on page 619.
Thank you.
Thank you.
All right, you all said revenue center. This is actually an investment center. So because it's it helps if you have the book in front of you and not just rely on the picture. We're talking about Baskin-Robbins, not that specific store, but Baskin-Robbins as a subsidiary of Dunkin' Brands. So Baskin-Robbins is thinking not only about their profit, not only about how much money they're spending and the revenues, right? They're worried about profit, but they're also worried about investments. Where should they set up new stores? Don't worry. I got another one. The legal department of the Progressive Group of Insurance Companies prepares its budgets and subsequent performance reports on the basis of its expected expenses for the year. Cost center, revenue center, profit center, investment center.
Can you repeat that?
The legal department of the Progressive Group of Insurance Companies. Okay, answers are coming in. 82% of you voted. And most of you got that right. This would be considered a cost center. So the legal department's just, their primary focus is managing their costs. Oh, I don't want to do that. I want to do this. This is the online division of David's Bridal Inc. Reports both revenue and expenses. The online division of David's Bridal reports both revenue and expenses. If you're not familiar with David's Bridal, that's because you're not married or engaged or intended. Answers firing in. And that's the poll. And most of you nailed it. It would be considered a profit center. They have both revenue and expenses. This one is Time Warner's investor relations website provides operating and financial information to investors and other interested parties. Time Warner Inc.'s investor relations website. I'm watching the answers come in. I'm just going to tell you, I haven't seen anybody get the right answer yet.
Oh.
Can you put it just one more time, please?
This is the Time Warner investor relations website. It is a cost center.
Can you explain that one, please?
Well, I just thought you guys were just going to believe me for no reason.
What is it?
I was like, really? No one's going to explain this? No one's going to ask me to explain this? So investor relations, that's a department where their sole focus is to manage public communication, okay, and make sure that all their investors have access to publicly available information. So they manage a website, and most companies will have a website for investor relations where you can access their 10K, their 10Q, but they're just a cost center, right? All they're doing is managing how much spending to do this process. They're not responsible for generating revenues. They're not responsible for the profitability of the company, and they're not making decisions on, what capital investments should we be making. Don't worry, you have another chance to get it right. This is the manager of the Speedway convenience store, which happens to be located on Verona Road in Madison, Wisconsin, is evaluated based on the store's revenues and expenses. There were some key words there, and those words were not Verona Road or Madison, Wisconsin. There you go. Way to redeem yourselves. Answers pouring in. And just waiting on one more person. You know who you are. There you go. 67% of you are correct. Manager is responsible for both revenue and expenses. Let's try another one. All right, this one is a charter airline records revenue and expenses for each airplane each month. Each airline performance report shows its income, including its revenue and expenses. This reminds me of just finished watching Black AF on Netflix. It's an episode about flying a private jet, which I thought was hilarious. Okay. It's always good to be in the majority, particularly when the majority of you got this one correct. No, yes, profit center. Sorry. Yeah, got it correct. It's profit center. Because it says here, I think these are the people reading the book, that it includes each airline's performance report shows its income, including its revenue and expenses. All right. What do we say? The manager of the Southeastern Sales Territory is evaluated based on a comparison of current period sales against budgeted sales. Just watching the flurry of responses. And again, congratulations. This would be a revenue center because this manager is evaluated based on current period sales against budgeted sales. And if you're following the book, you know we got one more left, so y'all can finish strong. This is the bakery department of a Kroger grocery store. Reports income for the current year. Oh man, it's like watching a sporting event. All right, I'm going to call it a narrow victory. This is a profit center because it's reporting income for the current year, which is income is your revenue minus your expenses. Questions?
So for investment center, and if they're responsible for income and invested capital, that's not the same as, or that's different, obviously, than the profit center. How do we distinguish between those two? How would we know?
So if it's responsible for, it kind of cascades or builds on one another. You've got just your cost center, you've got just your revenue center, and then on top of those, you have your profit center. Okay. On top of that, you have your investment center. So they're managing profitability and capital investment.
Okay, so if the question just asks if it's for income only, it's not related to the investment center. It's going to be your profit center. Unless it's sales revenue, then it's revenue center.
If it's just focused on the revenue, then it would be the revenue center.
Okay.
And these are important because we're going to talk now about some typical reports you'd see at these various levels. Okay, so we'll start with the cost center and the revenue center. So what these, for these types of responsibility centers, they're going to prepare what are called variance reports. And variance is just a fancy word for difference. What's the difference between your actual revenue and your budgeted revenue, or your actual costs and your budgeted costs? What did you think you were going to do versus what you actually did? What's the difference? That's what a variance report is. The variance report gets, we describe it in one of two ways. Okay? So when you have a difference, it's either going to be a favorable difference, okay, or it's going to be an unfavorable difference. Okay? What we mean by, well, not we, I didn't write this. What the book means by favorable difference, I guess it's what we as accountants mean, I use this term too, is if the difference results in your operating income being higher than you anticipated, that would be considered a favorable difference, favorable variance. Okay. If the difference results in your operating income being lower than what you expected, that would be an unfavorable variance. So let's do some chatting. Let's be chatty. Oh wait, are there questions in the chat room? Oh, ha ha ha, so cute. That was a long time ago. That must have been for Lucas. All right. So let's say a company expected to generate $900,000 in revenue, but they actually generated $950,000 in revenue. Would that be a favorable difference or an unfavorable difference? Just type your response into the chat room. They expected 900,000 in revenue, and they actually got 950,000 in revenue. Okay. All right, I get it. All right. Got it. Okay. All right. Good. Great. Now, let's say a company expected to spend $900,000 in accounting fees, and they spent $950,000 in accounting fees. Would that be a favorable or an unfavorable variance? Yeah, okay, good. If you haven't typed it in, just look what everyone else is writing and just write that. Good, excellent. All right. So it's not just looking at the difference in the numbers. You have to ask yourself, if it's making my revenue go up, that's favorable. Okay. If it makes my revenue go down, that's unfavorable. If this difference makes my expenses go up, that's unfavorable. Okay. Because when my expenses go up, my operating income goes down. If this difference makes my expenses go down, that's favorable. Because when my expenses goes down, my operating income goes up. Let's do an example. I can switch over to this thing here. relying this much on technology, man, that's the scariest part. Okay, so this is an example from the book, and we're looking at the actual sales versus what we budgeted for food, dessert, bar, catering. Okay. So to get the difference, okay, we take to get the variance, we take the difference between our actual minus our budget. This is our actual minus our budget. Okay. So, see my calculator. I didn't do this in advance. So our actual sales was 144,300, and our budget was 148,000. Okay. So that gives us a variance of 3,700. Okay. This minus this. This would be considered an unfavorable variance, okay, because we expected to get 148,000, we got 144,300. We also not only look at the variance as a dollar amount, but we look at it as a percentage amount. Okay, so to get that, you divide the variance by the budget. Okay. So in this case, our variance is 3,700. Our budget was 148,000. 3,700 divided by 148,000 is 2.5%. And again, that's unfavorable. You probably can't see that. That's a 2.5%. Questions on how that math is, how we did that math? Go ahead.
So the 3,700 came from where again? It's just the difference between 144 and no. Right. No, yeah, it is, right?
Yes, it is.
Okay, okay. I see now. All right.
So if we were going to do the variance for desserts, right, we take the difference between 16,100 and the 17,500, which is 1,400. Is this favorable or unfavorable?
That is favorable.
Unfavorable.
I'm seeing unfavorable. I was expecting to get 17,500. I only got 16,100. So that would be unfavorable. To get the variance percentage, okay, I would take the 1,400 and divide it by the budget of 17,500. 1,400 divided by 17,500 is 8%. Unfavorable.
I have a question.
Yes.
The variance is always positive number. We should not write like a negative number, because when we the difference between 1,600 is and 1,750 is minus 140, but in here the variance is we write it like positive number.
I think it's a good habit to write it as a positive number and then say whether it's favorable or unfavorable in this class. And here's why. Because if we were looking at this as an expense, right, or this as an expense, right, and we'd have a negative here, that negative is actually a good thing. If we budgeted to spend 17,500, but we only spent 16,100, that's a good thing, even though it would still be a negative number. Right? So until the people that are using the report, you all are comfortable with what positives and negatives mean when you're talking, which in this class, I don't think we're going to get to that level of familiarity. It's better just to use it as an absolute number and then say whether it's favorable or unfavorable.
Okay. Thank you.
And chances are, sometime this week or next week, I'm going to start using positive and negative numbers. And just call me out on my BS. Be like, I thought you weren't going to use it, because I'm sure I'm going to revert back to it. All right. Oh, because I'm imperfect. All right. The bar, 52,250 minus 55,000, 2,750. And that also would be unfavorable.
Mhm.
2,750 divided by 55,000. 5%. You know, if I wrote this problem, I would have some favorable and some unfavorable. But you know, what do I know?
So is there like,
Maybe I should write a textbook while I'm on. I'm just thinking to myself. I should write a textbook while I'm quarantined.
I was gonna ask real quick, is there like a certain percentage that's like good versus bad? Like, do you want to have a high percentage or a low percentage?
Oh, we're going to talk about that in real quick. Let me just finish this last one here. 2,520 divided by 42,000.
Is catering a cost though, or an expense? I see like food, dessert, and bar would be, you want to make some sales, but okay, I see. So then the catering is also sales. Generally.
Yeah, so we know this because this is a performance report for a revenue center.
Ah, okay.
And this is all about sales revenue.
Okay.
So this is money that they received from all those different sources.
It could be like a catering fee, like some big catering companies charge fees for like them coming out and stuff. Something
Sure.
like that. Yeah, I don't know.
Okay, so any questions on how we got these numbers? Because Alyssa's point is a good one. Well, at what point do we care about a difference? Here's what we know. There's going to be a difference between what we budgeted and what actually happened, right? There's always going to be a difference. Okay? At what point do we say we need to understand why there's a difference? Okay. So what we have to do, what a manager does, the company does, is they set some arbitrary threshold. So let's say for this company, they're only going to go back and ask questions if the variance is more than 2,000 and more than 5%. Important thing being this here, and. Okay. If it's more than $2,000 difference and it's more than 5%, then we're going to go back and say, wait a second, what happened in our budgeting process that caused this big difference? So if we use that as our threshold, go back. If we use that as our threshold, okay, we won't ask any more questions about food. Okay. This difference here is about 3% from what we budgeted, which is actually pretty doggone good. Okay. So we're not going to ask any more questions because we recognize there's always going to be differences. Okay. Same thing here with dessert. Okay. We're not going to ask any questions about the difference because it's only $1,400. Okay. And so even though it's 8%, it's not both. Okay. Catering, we're going to go ask some questions. Okay. Because it's more than 2,000 and it's more than 5%. Okay. So to us, this is a big deal, okay? Because we said this is a big deal. So this would be a big deal. We go back to the person in charge of catering and say, what happened? Why are we off by more than 5%, more than $2,000? Sorry, I just thought I saw somebody walk through my driveway. Not a drive-through. I don't run a restaurant in my house. With the bar, I guess maybe we look at this too because it's 5% and it's $2,750. Okay. So it kind of meets our threshold. So we go back and ask questions about what happened at the bar. We expected these guys to drink more than they got. Does that make sense? Are there questions? Would you like to try your hand at it?
Sure.
All right. P1048A. So hopefully you have your books. If you don't, here's a copy of it. We're only going to do 1, 2, 3, 4, 5, 6. Don't worry about number 7. Okay. So want you to complete this. Okay. And actually, let me take that off. You should probably take a picture of this if you don't have your book handy. Complete this. All right, that's number 1. And then, sure, guess what type of responsibility center it is? If this is what's important to management, 13,500 and 16%, which one of these would we have to look at? Okay. And then these other ones to think about. Okay. So I'm going to, you can take a picture of this slide. I'm going to put us all into some breakout rooms and give you all about 15 minutes to work on this. And once you feel like you have the right answer, or if you have questions, you can always invite me to your breakout rooms, and you all may leave now.
Should we make a cohesive document like the last one?
No, we're not going to come back to this. But you all can work on it together, like on one person's screen if you like. But this is not a continuing problem.
Are we doing all 1 through 6, but not 7?
1 through 6.
1 through 6. Okay.
So Megan, Samir, Stanley, Ishan, you all should be able to join your groups. Let me know if you know how to get into your group. Also looking at the investment evaluation report, okay? So you're looking at what's my return on investment. To get the return on investment, you can take the operating, and this can be by segment, or it can be the company taken as a whole, be by division. You can look at the store level, and you're dividing it by total asset. Okay? So it's your operating income divided by your total asset. Okay? If we were to break this down, what we're looking at is, this is our sales margin times our capital turnover. That's how we get our return on investment. The sales margin is your operating income divided by your sales. Okay. So in other words, this is saying for every dollar of sales we generate, how much of it goes to our bottom line. The capital turnover is looking at, for every how efficient are we in taking our assets and converting it into sales dollars. So how much sales are we generating per dollar of asset that we have? Okay. And then if we were to do some old school algebra, your operating income divided by sales, I don't know if it's old school, times your sales divided by your total assets equals, right? And you remember how you can get rid of both of those. That equals your operating income divided by your total assets. This is your return on investment. Questions? All right. Guess I'll just talk about this real quick. Residual income, this is another benchmark measurement. And this is basically your profit in excess of what your minimal acceptable profit is. Okay. This is also kind of like what we talked about before the last exam, your safety margin. What's your, you just need to know what's my target, what do I want to achieve? Anything above that would be considered residual income. All right, so before we get into this next one, is it okay with you if we take a 10-minute?
Could you go back a slide, sorry, to the one before the yoga people?
Residual income?
Yes, please.
The one before the yoga people.
Thank you.
Sorry, my markings went away. All right, so why don't we take a 10-minute, and then we're going to come back and we're going to talk about the yoga people. All right, 10-minute break starts now. I'm going to put a nice little timer up. All right, we are officially on break. All right. I'm going to continue the recording. Oh, I didn't pause the recording. Okay. So, kept recording. Got that 10-minute break. Hope you all enjoyed that of doing nothing. We're now going to talk about flexible budgets. Okay, so actually, let me just make sure you guys are all back with me. It's like seeing faces. All right, am I seeing some thumbs up? Got the thumbs up. Let me know you're here. All right, excellent. So let me just show you what a flexible budget is. So talking about gummy bears. So I love gummy bears. To me, that's an essential need. So I do go to Safeway still and pick up my bags of gummy bears. Let's say we had a master budget, and we'll keep it simple, right? We expected revenue of $300, cost of goods sold to be $100. We're a gummy bear company, and our selling costs are $50, and our fixed costs are $85. So based off of this, our expectation of our net profit would be $65. 300 minus $100 cost of goods sold, minus the selling cost of $50, minus the fixed cost of $85. But let's look at what our actual results are. Okay. So let's say we actually had revenue of $130. And let's say our cost of goods sold at being $137.50. Our selling costs were $66, and our fixed costs were $75. So just on first blush, when you're looking at this, did we do good or not good? Just drop it in the chat. Good, not good. What we budgeted versus the actual. See, good, 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 good. G, which I assume stands for going to hell, not good. I don't know. G's, okay. Why are fixed costs lower? Okay, we're already asking the questions. So our actual revenues, our actual net income, right, is $330 minus $137.50, minus the 66, minus the 75. Our actual revenue is $51.50. Okay, so I'm seeing some good questions being asked in the chat. Tram saying what the number of units did those increase? Okay, well so before I answer that, Tram, we budgeted for $65 income. Our actual income is $51.50. So that's actually not good. We thought we'd get $65. We actually only ended up bringing in $51.50. So we can dive into these numbers more. Okay? And this gets to your question, Tram. Let's look at what's making up the $300. So it looks like we budgeted to spend, we budgeted to sell our bags for $3 each. And we planned on selling 100 bags. Okay? So that's how we got the $300. We thought we'd spend $1 per bag, right? So then what we sold, 100 bags, so that's how we got the $100. We expected our selling cost to be 50 cents per bag, and we expected our fixed cost to be $85. But what actually happened on this side, okay, is we sold 110 bags. Okay, and our cost of goods sold wasn't $1 per bag, it's $1.25 per bag. Okay. And our selling costs weren't 50 cents a bag, they were 60 cents a bag. we did manage to save $10 in our fixed costs. Okay. So now that we have this information, is our actual versus our budget good or not good? You can type it in the chat. Not good. I'm seeing one not good. I'm seeing
What are selling
110 times 3.
That was my bad.
Oh, I'm seeing good. Selling costs would be commission, packaging.
Oh, okay.
Yeah, any other costs. It could. Yeah, I guess I'd leave it at commission.
So it basically is their budget, and so what they think it's going to be, but then when it actually happens, so say for packaging, they thought it was 50 cents, but the person that they buy it from raised their prices and they didn't know. Is that why there's such a difference, or how could they be more accurate in their budgeting?
So there's a lot of reasons why these things could be different. Okay, so let's start with the, let's start what we can control, right? We can control how much we're charging per bag, right? And so unless there's another vendor that's also selling gummy bears, which forces us to lower our prices, or unless there's a shortage of gummy bears, which allows us to raise our prices, we're setting that revenue price, right? And so $2 and $3, that's what we can control. The other things are really kind of outside of our control, right? So cost of goods sold, we thought we can buy the bags of gummy bears for $1 each. But it turns out, I don't know if you ever bought gummy bears from Target, but they used to be $1, and then they raised the price to $1.19, which my wife keeps saying, why are you making a big deal? But that's a 20% freaking increase, you know? I still buy it, it's not 20 cents, but it's a 20% increase. But if I need these gummy bears, then I'm gonna have to pay that additional price. Okay. With selling costs, we'd have to define what selling costs were. Let's say the selling costs were commission. Okay, we've got someone out there hustling these bags for us. Okay, and the normal person that we work with, or this person said they would charge us 50 cents, but they came back and said, I'm going to charge you 60 cents per bag. Or if I sell more than 100, then the average price goes up, right? So maybe that's the reason why it's gone up. Right? There could be all types of reasons. And then with fixed costs, right? Again, we expected a certain rate, and thankfully when we got there, that rate was lower than what we had anticipated. Or maybe we baked in additional taxes and fees, and we didn't have to pay all those taxes and fees, which caused it to go down. I'm seeing, so it's interesting because it's like 40 something people on here, but only like 10 people said good, not good. Okay. So here's the thing. We're not going to compare the master budget to the actual budget. And here's why. This is what we need a flexible budget for. Because this is like comparing apples to oranges. Okay. The master budget assumed that we would sell 100 bags. Okay. And if we sold 100 bags, the expectation is that we would have earned $65. Okay. But we actually sold 110 bags. Okay. So what we want to know is if we had assumed from the beginning that we were selling 110 bags, what would we expected our net income to be?
Do you use the master budget cost of goods amount to figure that part out?
Yes. Let me say it one more time.
Yes, please.
So
Jared, I can
the
hear
flexible-
you eating.
Oh, I'm sorry. I thought I.
Okay. Just cracking constantly is driving me crazy. Okay, sorry, go ahead.
the flexible budget is doing a what if scenario. What if we budgeted
110 bags.
for what we had actually sold?
Okay.
What if we assumed that we weren't going to sell 100, we're going to sell 110?
Okay.
At that volume, what would we have expected our profit, our net income, our operating income to be? Does that answer your question? So let me answer your question. It's called a flexible budget because we're making some adjustments to the budget so that we can do an apples to apples comparison.
So are we going to change then the cost of goods sold per bag total for the flexible budget, or do we still use the master budget $1 per bag?
So here's what it would look like. So this is our
Okay.
flexible budget.
Okay. So
our
we do still
flexible
use
budget says
Gotcha.
the only thing we're adjusting for is our volume. Okay. So this gets back to this whole concept of fixed versus variable costs. Okay? So if it's a variable cost, right, like cost of goods sold, selling costs, that's all driven by how many bags we sell. Okay? So if we assumed that we would have sold 110 bags, not 100 bags, but 110 bags, we would have expected our revenue to be $330. Okay, 110 at $3 per bag. We would have expected our cost of goods sold, assuming we sold 110 bags, to be $110. Okay, all we're doing is substituting the 100 bags with 110 bags. We would have expected our selling costs to be $55, 110 bags at 50 cents per bag. Okay. And because the fixed costs are not tied to volume, we would have expected fixed costs to stay at $85. Now, watch this. If you take 330, all right. I'm so afraid to use this technology, but I think it'd be better if I did this here. So let me switch over to this iPad. It's gonna cooperate. You never know. Okay. So here, what we're talking about is our operating income is $51.50, right? That's 330 minus 137.50 minus, what was that, 66 minus the 75 gets us to 51.50. Okay. But when we compare it to our flexible budget, our revenues would be 30. Okay. Cost of goods sold, we would have expected that to be 110. We would have expected our selling costs to be 55 and our fixed costs to be 85. So when we're selling 110 bags, we expect there to be an operating income of $80. But we only got $51.50. Master budget said if you sold 100, you should have got $65, right? So I was teasing you all at first, asking you to compare the 65 to the 51, and you said, oh, that's not good, right? Because it's less than what we had anticipated. But actually, if we assumed that we were selling 110 bags, we would have thought we'd get $80. Okay? So we're really disappointed when we only earn $51.50.
So is that like a range that they look in between like the master and the flexible budget, like a different range of like operating incomes you could get? Oh no.
No,
No.
I'm going to say no,
Okay.
because this flexible budget gets prepared when we're doing at the end.
So after
This
it
is
already
done at the end. Yeah, so that we can. This is all so that we can calculate our variances.
Okay, that makes more sense now.
And we. Oh, good. Okay. Other questions? So
why we don't use subtract $75 for the fixed cost to get higher profit?
why don't we use 75 here?
Yes.
Because the fixed costs are not tied to how many bags we sell. Okay. This fixed cost assume this was the same whether we sold 0 bags or, I don't know, 150 bags. Our budget was that it would cost us $85. So that's because it's a fixed cost, we don't change that in our flexible budget. The only thing we're flexing for is for the actual units sold.
So we don't care about the actual cost?
No. So we didn't change here. The 1 is the 1, 50 is the 50, 3 is the 3, 85 is the 85. The only thing that's changing is the 100 versus the 110.
Okay. Thank you.
Of course. So you guys are asking good questions, right? Why did we end up having to spend $1.25 per bag versus what we budget for? That's really what's driving this huge loss, right? Is that we budgeted for $1, but we ended up spending $1.25 per bag. Yeah. We also need to understand why we were off 50 versus 60 cents. Again, 10 cents is not a big deal, but that is 66. That's an additional $11 coming off of our operating income. Okay. And of course, we're so happy that we saved $10. And our question is, how did that happen? Can we repeat that, right? Or was that just a one-time discount or something that we received? Because they felt bad because they charged us more here. I don't know. This is not going to help you answer the questions. This is going to help you ask the right questions. All right. I think we should just do some problems. Yeah. I'm going to All right, fine. I'll talk about this real quick. The point here is that we're focusing just on financial metrics, but there's more to a business than just its financial metrics. They also want to look at customer satisfaction. Okay? If you've ever been to a drive-through, sometimes you notice there's a clock in the window where they're tracking how long does it take for us to service one of our customers, right? And they're evaluated based off of their ability to, if you're a food restaurant, to get food out fast. Learning and growth. Okay. When I worked at KPMG and Deloitte, they kept track of, and even now, they keep track of how many learning hours are we doing every year. Okay. What are we doing to continue to grow ourselves so that we can become, better with the products that or the services that we provide. Okay. There's also internal business metrics. Okay. So if you are a website or an advertising agency, you're focusing on how many click-throughs do we have. Okay. Not just how many people are going to that website, right, and seeing our ad, but how many of them are clicking on that link to go to a different website. So that's another metric that companies look at. So those are just some examples. They're in your book. You can kind of read those in more detail. I just want you to get a sense of, I just really want to emphasize that it's not just financial that businesses are looking at. There are other metrics as well that a company looks at. It's on my mind, so I have to say it. I was reading this magazine, Small Business Owners Magazine, and they were talking about, we have to think about the return on investment when we get an influencer to promote our product. And he brought up Kim Kardashian. This was John, the guy that owned Fubu. He's on Shark Tank, black dude. He was talking about Kim Kardashian as an example. He was like, she has millions of followers, right? Millions of followers. But 40% of those people absolutely love her, right? And 40% of those people absolutely hate her. And then there's another 20% that are just guys that are just there because she's Kim Kardashian. They're following her. So when you say I'm paying for Kim Kardashian to promote my product because it's 1 million, she has 1 million followers, you're really only speaking to 40% of those followers, right? In theory, right? The people that like her and want to do what she's doing. The other 40% are like, oh, if that's what she's doing, then either I don't want to do it, or haters be, I'm gonna do it, but not because of her. You know what I'm talking about. And then the guy. Anyway, complete sidebar. All right, that's all I got. So I'm gonna let you all do some practicing. So there is a lab assignment that is available on my accounting lab. And I can't quite find it. Before I do that, why don't we choose, oh, she asked it, okay, answer that question. Are there other questions? So if you go onto My Accounting Lab, there is a lab assignment for today, E1039B, that you all can work on for the remainder of class. We can do it, it's up to you. You can log off and go work on it. And then if you have questions, you can log back in. I'm gonna stick around for until 7:50, so about another 35, 40 minutes. And, or you can just kind of stay here and work on it. If there's enough of us here and if you prefer, I can put you all in the breakout rooms, or if there's people you want to go into a breakout room with, you all can let me know. And I can do that as well. Are there questions? Everyone have a